Okay, so welcome back to the Millionaire Incorporated Forex Basics Trading Course, Module 6 on Risk Management and Psychology. So what we're going to cover in this section is risk management, what a stop loss is and how to set one, position size, risk reward and mindset. So now comes the most important part of this course, and that's how we manage our money and our trades. So have you ever gone into a casino with only about $100 and placed it all on one bet on roulette or blackjack and just hope for the best? I bet most of you are saying hell no. So what you most likely do when you go to the casino with $100 is that you find the table with the smallest allowable bet that you feel comfortable taking. So an example of this is like going to a $1, a $5 or a $10 a bet table. And why do you do this? Because you know that you aren't going to win every hand you play, and you may not even win the first hand you play. So what you're doing is minimizing your risk per bet and trying to give yourself some leg room to play and make up for potential losses if you have any, and eventually hopefully come out on top. So this is a similar thing in trading. You only want to risk a small portion of your capital per trade in the hopes of profit. So what a lot of courses and experienced traders advise is to only use between 2 and 5% of your capital per trade. Now, this is one of the safest options to use when trading, especially if you're starting out. This essentially allows you to place between 20 and 50 trades before completely losing all your money. And that's assuming that you lost every single trade in a row, which is highly unlikely. But if you are new to trading, you can lose a fair few in a row and have a significant amount of losses stack up against you. So while we always want to be profitable when we trade, sometimes we won't get it right. So we want to preserve our capital as long as possible and also limit what we can potentially lose if we don't get it right. So when we are placing our trades, how do we know how big of a position to place so that we are only risking 2 to 5% per trade? So we determine how much we are risking per trade by our stop loss size, and that will in turn determine our position size. So a stop loss is like a piece of insurance you place on your trade, so that if you are wrong about your trade and your setup, you don't lose all your money. So I advise that this is a must thing to do when you're trading. So it limits your losses and allows you to preserve your capital, which is all part of risk management. So there are a couple of places that you can place a stop loss. So you can place it at the low of a previous candle or area you've been looking at, or you can place what we call a structural stop. So what a structural stop means is that you're placing your stop loss below a lower low in a nearby area or a higher high in a nearby area if you're short. So this is where it becomes very important to be able to look at market structure and what's in the near vicinity of when you're placing your trades. And this will also allow price to move and develop and hopefully go in the direction you are outlining without being stopped out too quickly. And some people like using what is called a fixed stop. So this is where you have a fixed pip count set as a stop loss. So you could use say 10 pips, 20 pips or 30 pips depending on what you like to risk per trade. I don't like using fixed stops personally, because some candles and areas can be very large, which means that you could get stopped out mid-move before the price goes in your direction. So we'll jump over to a chart so we can actually see what I'm describing here for you. So we're going to look at how we can determine our stop loss now. So this is on a daily time frame, so I'm going to draw in a trend line. So grab my trend line tool here. I'm just going to quickly draw it in just there. Then I'm also going to take in a support and resistance line. So I'm going to take my horizontal line, and I'm kind of looking at this area just here. So you can see there, prices kind of came up to it before, struggled to break through. And as it's come down, it struggled to break through again, and as it's passed through and it's come back up, it's actually created another area of resistance. And it's in line with that trend line there as well. So we've got a high probability chance of the price moving back down lower again. And if we take our Fibonacci retracement tool here, draw it from the top of that one there, coming down to the bottom of that move there, it's kind of in line with that 61.8. So it's pretty much three three confirmations in that one area. So it's probably a high probability trade to actually take. Now, let's just quickly remove that and that there. So as it comes back up to that trend line just there, we want to try and find areas for an entry, and then work out how large our support is, our stop loss is. So I'll drop this down to a 4-hour time frame. So here we're looking at that Aussie USD on the 4-hour time frame. So I'm just going to zoom into this area here where we're actually looking at for that short there. So I'm just going to take the zoom in tool and take it into there, tidy it up a bit as well. So you can see here on that 4-hour time frame that as the price came in contact with that trend line, it made a move away, and it was a reasonable move away, engulfing the previous candles as well. So where you would set a stop loss is there's a few spots. So you could either set a structural stop at the high of the previous high in that area, which would be at the top of this candle, this green candle just here, which is roughly 20 pips. And you probably want to set it a couple of pips above that as well, which is currently 24.4. Or you could set it at the top of that recent candle, which is roughly 17 pips. And that's why I like using structural stops more so, because you can actually have price move more than a set pip amount of a stop. So if you were to use that area there as a stop loss, like say just here, and it had a 10 pip stop, if it was to reach 10 pips, you're almost going to get stopped out just from that move just there as it retraced up higher. So you can see that's probably 1.5 pips away from getting stopped out, which can be almost enough to take you out and definitely play on your emotions. So now that we've determined how large our stop loss is for the trade we are taking, we want to determine what position size we are going to use for our trade so that it fits within our 2 to 5% risk per trade risk management. As I was saying, this is where our stop loss size, spread and commission comes into play. When we are placing our trades, our stop loss plus spread and commissions will determine how much money we are risking per trade and how large our position size should be for that trade. Now, there are formulas that can actually help you determine this, but I don't even use them anymore, as there is a much easier way to work all this out. So the guys at MyFXbook have created a section on their site where you can plug in the trade you want to take, what your stop loss is. Remember to add the spread and the commission to try and cover any extra variance there. The percent risk per trade you want to use and how much capital you have. And you put this into their calculator and it gives you what your position size should be for the trade you want, for the pair you are looking at. Now, if you're starting out with a very small amount of money, say $200, you might only be doing positions of 0.1 per trade. And this, when you do these as well, it might actually be larger than that 2% or 5% risk per trade we recommend. Now, I wouldn't completely agree with doing this, but if you're happy with placing trades and risking more than what we're saying, that 2 to 5%, that is completely up to you, and you have to be able to be comfortable with the amount of risk you take per trade. So remember, trading is a lot about patience, and you want to be compounding your returns over time. So you can find this calculator if you go to Google and just type in risk calculator, Forex risk calculator, and jump to the MyFXbook link, or you could just go to myfxbook.com, and I think it's one of the tabs at the top there. Now, not only does risk management mean how much you are risking per trade, but you also want to make sure what you are risking has a reasonable reward. And this is called the risk to reward ratio. And this means the amount or the ratio of reward to how much we are risking per trade. And this is determined by a couple of elements. So those two are the stop loss and the price projection of that pair. So that's where the Fibonacci extension tool comes into handy later on. So that's where you kind of project the price out and then use our stop loss. So the higher this ratio, the better it is for us. But it doesn't necessarily mean that our trade will reach our projection. So you could have, say, like a 10 to 1 risk reward ratio, but for a price to move 10 times your stop loss is quite a large move, especially if you have a large stop loss. So if you had 50 pip stop loss, for it to move 10 times means it's a 500 pip move, which is a significant move. It can definitely happen, but it also means that it will take a lot longer for that move to eventually happen. Now, as you get better and more experienced at trading, that might be something that can actually happen for you. So there is a tool on the charting software at TradingView that can help create trading plans and give you the risk reward trade ratio for the outlined trade. And when we are placing trades, we want the risk reward ratio to be above 1 to 1. If over time we're leaving it at the 1 to 1 and we're wrong more times than we are right, we will be losing money. And this is because for every trade we're taking, say we're risking 30 pips for trade and for a 30 pip profit, and if out of 10 trades we're right only 4 times, that means we've lost more than 60 pips overall. So this is where we want to be looking for trades with 2 to 1 or 3 to 1 or even higher risk reward ratios if you can find them. With a 2 to 1 risk reward ratio, that means the trade we take, we can be wrong more times than we are right and still be getting ahead. And when the risk reward ratio is 3 to 1 or higher, this means that you only literally have to be right once every 3 trades, and you're still going to be making money on your trading plan and getting ahead. So this is great because as you become more skilled at predicting trades and actually marking things up and analyzing everything, you will actually start growing your money faster and compounding things a lot faster. So this is why you also want to be very consistent with your trades and sticking to your trading plan. So we'll jump over to the chart again just to have a quick look at the chart, an example of a chart plan. So from that similar example again, let's draw in a trading plan to work out our risk reward. So we'll draw in that resistance area again, which is just roughly here. Let's draw in our Fibonacci retracement, which just goes to about there. And we'll draw in our Fibonacci extension tool as well. So I'm just going to move that across a bit more. So we take our Fib base extension, start from there, go to the bottom, and take it across. So try to line up as best you can. So let's draw our trading plan now for this example. And we're going to use this candle just here. So we're going to set the stop loss at just above that previous candle and try to work out what our risk reward would be if we wanted to do a take profit at the 0% where it's made the previous lower low, or at the 23.6% extension. So to grab our trading plan from over here, which is in this scenario a short position. So we're going to click it just at the base of that candle there. And you just got to do a bit of modifying. So drag that down there to be just above that candle. And we'll excuse those ads. And we'll take it down to the extension of that 23.6. And you can see there, it's like a 4.5 to 1 risk reward ratio if it completed that entire move. And that's to that 23.6% extension. And just for that, for when it reached that lower low, you can see there it's actually about 3 to 1 risk reward ratio. So this is a great tool to actually work out if your trading idea is going to reach a take profit area and if it's worthwhile hitting those 2 to 1, 3 to 1s. And if it does, then it'll be a good opportunity for you to take that trade. Now, while all this is well and good with creating trading ideas and plans and looking for trades to take, one of the hardest skills to develop is actually a trading mindset. So, how did you feel about the first time you placed a bet at the casino or on the horses or in a sporting event and watched it and then lost money? I bet it played strongly with your emotions. There are probably a lot of emotions of hope, joy, sorrow, and pain if you lost. And there has been a lot of research on this topic, and it has found that the pain of losing money is twice as strong as the joy from winning money. But we were so wired to hold on to something that's going negative in the hopes that it will turn and become positive, so we can become right, and then eventually we make our money. Unfortunately, though, we end up losing money a lot more, and we probably should have closed it when we were ahead. So trading is actually a lot more emotional than gambling, especially when gambling at the casino or placing a bet on a sporting event. And this is because I've looked at it as a duration of the bet. So at the casino, your bet usually lasts a couple of minutes at most, and it's either a win, lose, and you occasionally have a draw. And you don't have any control over it at all. With sporting events, you have to wait the entire duration of the game being played, such as in football or soccer, it's 90 minutes, and there are ups and downs when one team takes a lead or misses shots, but it's usually over relatively quickly and will either be win, draw, or loss, and same thing, you have no control over what's actually happening. With trading though, trades can take from minutes to hours, days, or even weeks to see the final outcome of your trading plan. And during this time period, the price of that pair is going to be moving from loss to profit, back to loss, from great profit to less profit, before finally reaching either your take profit area you set or hitting your stop loss for the trade you set. And during this entire time, you can see your investment going through all these ups and downs along the way, and you're watching it especially if you're watching it the entire time, and you have a certain level of control over it as well. So you might think to yourself, I might be able to take it out here and be profitable, or what if it goes the opposite direction, or what's going to happen? And this can be a terrible thing to do because you'll expose yourself to all the emotions as your trade does its thing. So when in trading, you want to try and take out as much emotion as possible from the trade and just let it run its course and not get too greedy with your trade. So as well as this, you need to be able to learn to look at the chart as little as possible and let the trade just do its thing. So this is something I have done over and over again. My friends have done it too, and I can almost guarantee almost every trader out there has done it at some point as well. They get into a habit of checking their trades over and over again quite regularly, seeing the profit, seeing the loss, seeing which way it's going, and going through all those emotions again of joy, anxiety, greed, whatever. So this is where you have to be extremely disciplined with yourself. You have to be strict with yourself with sticking to your limits of how much you're risking per trade, setting stop losses, and letting the trades take their natural course. Otherwise, you'll do what I did and lose thousands of dollars chasing losses, hoping it'll turn and become positive again. And most people get greedy as they want the results of trading to come quickly. This is where all the top traders and myself stress to be disciplined. Discipline is what separates poor and average traders from successful, highly profitable traders. You have to stick to your trading plan and not deviate from it. So many people out there are happy to leave their money in banks for around 2% interest per annum or place it in stocks for around a 5 to 10% return per year. But when it comes to trading, people trade based purely on emotion and greed and want the returns of success to be as quickly as possible, and they want to be compounding their money as quickly as possible. So they go, oh, I've made 5% today, let's go for another trade, let's try and get it 10, or let's hit 3 profitable trades and just keep trying to do that. Unfortunately, you won't get it right every time. Your ego will play into that, and when you have that loss, you start chasing that win again, trying to build up your ego again just to make yourself feel better. So be patient with trading. Take your time to grow your account. This is where the theory of less is more plays a major role. So focus on a couple of pairs and really get to learn them. Learn how they move, how they react to news and events, and the times of day when they are slow, when they tend to move quickly. And then all you have to do is wait for the charts to set up during the week and place a single trade or a couple trades a week. Use correct risk management, set your stop loss and your profit target, then sit back and relax. And another reason why trading plays with your emotions is the way it moves. So when a trade is going against you and you lose, one thing not to do is what we call revenge trading. So don't jump into a trade wanting to or hoping it will make your money back. 99% of the time that won't end well, and you'll ultimately lose your more money. Not just that you are trading against your trading plan, but you have blindly jumped in, and this is what is called revenge trading. So markets are irrational, and you have to learn to accept that a trade setup may not have been right. So what some traders do if they have a loss is they actually walk away from the charts and come back the following day, because they understand how a loss can affect their psychology and their mental game in trading, and they're likely to make more mistakes if they don't allow themselves to psychologically recover from that loss. So this is all you literally have to do as a trader. Look for opportunities, see what is going to give you the highest probability of success, set your trade parameters as in position size, stop loss and profit targets, then sit back and relax. Let the trade come to you. And that's basically all you have to do for risk management. You just have to be patient and allow yourself to watch charts and only take the trades which are going to present to you opportunities of success. Set your risk parameters and let a trade do its thing. That's the end for this section. Stick around for the next part.